Tax is a huge determinant of your total return outcome. Here are some general rules for how tax may work with foreign investments. The company is taxed at a corporate level. So, in almost every jurisdiction, companies will have to pay a corporate tax rate on any income earned. With international investments, there's no franking credits, and so the corporate tax paid can't be offset or recouped. If you've received a dividend, in the eyes of the ATO, any investment income you earn in or out of the country has to be taxed. In most cases, the country that you're investing in will also require the investment to be taxed. The US does this automatically through withholding tax of 15%, but not all countries withhold tax. So an example of this would be the UK. To limit double taxation, investors are given a foreign tax offset in the case where there's a withholding tax from the investment's country's origin. This can be claimed as a credit against the Australian tax payable on foreign income if you're an individual investor, or if you're investing through a trust. To understand how to structure your investments to maximise your return, it's best to speak to a tax professional that understands your individual circumstances. In the case of selling your investment, if the time does come to sell it, this may trigger capital gains. Capital gains tax on international investments are taxed the same as Australian investments. So you'll still receive a CGT discount on any asset that you've held for more than 12 months, and the remaining gain that you have made is added to your assessable income for the year. Some countries where you've invested may have a capital gains tax or equivalent that you'll have to pay. If you have paid this tax overseas, you might be eligible for an offset. If you're investing internationally through managed funds or exchange-traded funds or ETFs, that's one of the reasons that you pay management fees on those funds or ETFs, and that's because they're managed. The general rules of tax that have been discussed above still apply to these vehicles, but it's a simplified process at tax time. So you don't need to declare the income and the capital gains from each of the assets that's contained within the investment.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.